Get Rich Education is brought to you by Norada Real Estate and Ridge Lending Group.
Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
Hey, welcome to GRE. This is Get Rich Education, episode 75. Yes, I'm Keith Weinhold, but who cares who I am because you're not here for me, you're here for you. So welcome in. I'm here to help make you more successful than me, faster than me. And you know, I've concluded my fantastic, idyllic, expansionary 10-day or so experience here on the Real Estate Guys Investor Summit at Sea cruise. What an exhilarating event. This event is kind of a combination investing conference / Caribbean cruise / networking event where we had 1 to 2 days of class on land in Miami, and then we went on a week-long cruise. So you get everything from Caribbean sand between your toes to real estate and investing knowledge between your ears, and there's really nothing else quite like it. It's also the highest end real estate investing event that I know about. So, you know, besides just the time invested, I and the other attendees, you know, we also paid about $10,000 of our own money to attend. And you know what? The event delivered. I expected this to be the best investment that I make this year, and it sure does look like it was. And I'm going to give you my top takeaways today, which is going to take little of your time, certainly not the 10 days that I invested, and it's going to cost you nothing, not the 10K that I spent. So, and you know, I've even got some pointed market predictions to share with you today that are from the most connected insiders. Now, when you have time and money barriers like that just to get into this event, I mean, just kind of think about the caliber of attendee that's there, okay? There were 144 of us summiteers, as we're known, and, you know, these people are doers, all right? In fact, at one point in our floating conference center on the ship, anyone that invests in income property, they were asked to raise their hand, and almost every one of the 144 or so hands was in the air. So when you're on the summit at sea, you're in the presence of doers, and you know, you want to get around people that are doing what you want to do, not just blogging about it or podcasting about it or trying to sell you a course about it or just thinking about it. You know, you want people that are doing the thing. Now, the presenters, you know, also known as the faculty on the summit, they were truly extraordinary, as you're going to learn about here. Rich Dad Advisor Ken McElroy and his partner Ross McAllister, they presented together on stage. They're some of the most successful real estate syndicators in the world, okay? They pool other people's money and go identify investments and go ahead and match their money with investments. And Ken and Ross, they're collectively MC companies. They have more than 10,000 apartment units at last check. Now, we're talking about one of the most successful real estate investing partnerships ever here, okay? MC companies, McElroy and McAllister. All right, now about partnerships, they iterated that, you know, most partners, they look at the numbers. Prospective partners get excited about the numbers, and then they partner, and it often falls apart because you really need to look at the people that you're partnering with first, okay? Your partner is more important than the numbers in any deal. You and your partner need to have an aligned history, vision, commitment, and kind of a compatibility with each other before you go ahead and partner. Now, Ken and Ross, they knew each other 15 years before they partnered. That's why they're successful. It's not because of the numbers. You know, vet your partner well first. Otherwise, you will be dead, okay? By the way, you can listen to Ken McElroy here on the show with me. He appeared on episode 25. And Ken is also scheduled to come back on the show here with me in a couple months. But anyway, my sidebar take here about partnership It's kind of, okay, there is a reason that this saying exists, okay? The saying is partnership is half the profit and twice the problems, all right? The reason that exists is because most prospective partners go chase the numbers first rather than investing the time in a principled and aligned partner. It's kind of a simple thing, but you just can't overlook its importance. Now, later, there was a great panel of 8 speakers that assembled in front of us up on the stage. And it was, the panel was named The Future of Money in Banking. And it was G. Edward Griffin, Anthem Blanchard, Brian London, Robert Kiyosaki, Simon Black, Peter Schiff, Patrick Donahoe, and then Jim Rickards appeared live via FaceTime. Okay, now that is one high-powered group of big brains and huge influence. And there are some real insiders there, okay? And the moderators of the panel were the hosts of the entire event, the real estate guys, Robert Helms and Russell Gray. Now, on the Future of Money and Banking panel, Schiff and Rickards, they totally think the U.S. is headed straight for a recession. And these are really sharp, well-connected guys, some of the best-known authors in the economic world. They don't think that Fed Chairman Janet Yellen sees this yet. Now, Jim Rickards noted that gold is up 14% this year in U.S. dollars, at least at that time. That was a couple weeks ago now. But it's up 20 to 25% in British pound sterling and other currencies. And, that's something that's typically up when there's a great deal of uncertainty, okay? And, gold is typically worth more units of currency whenever there is economic uncertainty. Rickards says that despite the economic concern, the Fed will hike rates in both March, this month, and again in June. And only then is the Fed going to realize that they hiked into weakness and that they basically made a mistake. But Rickards, he actually believes that the days of quantitative easing, which is printing crazy amounts of dollars, which we had 3 cycles, Rickards believes quantitative easing is over. Yeah, that's right. And that kind of surprised me. Rickards thinks QE is over, all right? Now, he reminded us that, it's not really what you think or what I think that the Fed ought to do. It's what Janet Yellen, the chairperson of the Fed, thinks, okay? We aren't in control. And these are my words now, not Rickards' words. We are not in a capitalistic economy. We are in one controlled by the Fed. So whether you agree with the Fed or not, you better pay attention about what the Fed does and tailor your investing plans accordingly, okay? We're going to talk about that more. Now, look, if we're trying to predict the future, first, let's look at the past and kind of build our trajectory toward the future, okay? Look, Rickards says that QE is over. All right, well then consider this. Back in 2013, the Fed printed $1 trillion and they pumped it into the financial markets. Massive quantitative easing. That was massive QE. And that year, the stock market went up 30%. All right, the next year, 2014, the Fed printed just $500 billion, okay, less QE, and the stock market only went up 11%. Last year, the Fed didn't print any extra money at all, no QE, and the stock market didn't go up at all. Okay, and Rickards predicts that QE is over. So what do you think that's going to do to asset prices? That could be a $10,000 plus takeaway for you right there. Just think about that, okay? Now, Simon Black, he brought us up to date that the total debt burden of the U.S. government has now surged beyond 19T. Yes, $19 trillion. And by this point, you've got to realize that that's debt that we will never pay back. Now, that's not a difficult statistic to find. It's often cited in financial articles and commentary, but on the asset side of the U.S.'s net worth sheet, Simon let us know that the $1.2 trillion in student loan debt, that's actually the U.S.'s most valuable asset. Can you believe that? That's pathetic. So the most valuable asset that the U.S. has are loans outstanding, largely to millennials, students that have a difficult time finding a good income while they're more crushed by the weight of student loan debt than any generation ever. Okay, that student loan debt, That's the US's number one asset. Now, Simon talked quite a bit about the insolvency of U.S. banks, as he often does, and he reminded us about the, insolvency of individual Americans. 60% of Americans have less than $1,000 in savings, okay? Have you heard that stat before? 60% of Americans have less than $1,000 in savings. That's just nuts, okay? He also predicted, this is Simon Black, that negative interest rates are on their way to the United States. Yes, negative interest rates are coming to the United States. Brian London, who was also on the panel here, and he's also the producer of the New Orleans Investment Conference, Brian let us know that now fully 1/4 of the world's economies already embrace negative interest rates. And that includes Europe. So we're talking about advanced economies and developed nations here. But Simon is the one that said negative interest rates are coming to the United States. Now, for just a minute, let me sidebar off that for your benefit, okay? Let's discuss what negative interest rates are and what they mean to you, okay? Negative interest rate policy, or NIRP, N-I-R-P, as you sometimes see stated in the media. NIRP, that's when interest rates fall below zero, just as it sounds. It's meant to stimulate a sluggish economy. Now, first, let's just back up and talk about what an interest rate is. Because, okay, now here at the Summit at Sea, Peter Schiff gave, I just think, what's an elegantly simple definition of what an interest rate is. An interest rate is how much you're paid to wait. All right, it's how much you're paid to wait. So, for example, if you put your $1,000 in an account yielding 5%, you're paid $50 per year. Okay, so you were paid $50 to wait for a year to use your $1,000. So an interest rate is how much you're paid to wait. NIRP, negative interest rate policy, that says that if you have it now, it's cheaper than when you wait. So with negative interest rate policy, if you put a $1,000 in an account yielding negative 2%, then after a year, you'll only have $980. You'll have less than the $1,000 you started with. You had to pay $20 to let someone else borrow your money, the bank borrowing it in this case. So because you've effectively lent $1,000 to the bank, all right, so you have to pay if you lend away money rather than with positive interest rates like we have now and like what we grew up with and what we're all used to. That's where you get paid if you lend someone else money, all right? So just think about that. Negative interest rates are a little difficult to wrap one's mind around sometimes because up to this point in the U.S., we've always had positive interest rates, okay? Now, interest rates have been low for years, and the fact that they're low penalizes savers. So these low interest rates make one more likely to invest in business and industry rather than save, and that, in effect, stimulates the economy, or so the Fed believes. Again, it's not what you believe, it's what the Fed believes, all right? So therefore, negative interest rates, think about it, that would be an even greater reason not to be a saver and instead be a borrower. You're not just punishing savers moderately now, you're punishing savers punitively with negative interest rate policy, okay? Because you're getting paid to borrow. Right now, you pay interest in order to borrow. So with negative interest rate policy, again, you're getting paid to borrow. So therefore, if you're getting paid to borrow, you will effectively borrow more and drive asset prices higher, prices for real estate, stocks, collectibles, whatever, okay? Now, would we ever see negative interest rates for mortgages? I don't know about that. I kind of doubt that, but all you do know is you don't know. We keep getting into unprecedented territory with the things that we do. The U.S. has already done things that it's never done before. Quantitative easing that began in 2009, we've never done that before. That was unprecedented. And now insiders say negative interest rate policy is going to be coming to the United States. So we've never gone there before either. The U.S. has never had negative interest rates, and there is a growing consensus among both some of the Summit at Sea faculty, including Simon Black, and other economists that the Fed will take this drastic measure to keep the economy afloat. Peter Schiff just plain said that any raising of interest rates is simply not sustainable. The economy won't be able to take it. And you know what? Russell Gray, the co-host of the Real Estate Guys Investor Summit at Sea here and one of the moderators on the panel, he chimed in with a great analogy about how all of this applies to you and why this matters to you. Russ said that when you're in a room with a big, giant elephant, that elephant's movements affect you. Well, when the Fed is that elephant in the room with you, yeah, you're in that room with the elephant, and that elephant is the Fed. So whether that elephant is dumb and slow, or whether it's hungry, or whether it's aggressive and angry, you better pay attention to its movements, okay? The Fed is the elephant. You can't control the elephant, and it affects you. So you better pay attention to the elephant's movements, or you will get crushed. I don't want you to get crushed. Hey, coming back with more Investor Summit at Sea takeaways right after the break is we'll have some more real estate specific material. You're listening to Get Rich Education. Cash flow real estate investors, this is Get Rich Education's Keith Weinhold. Did you know that you can finance up to 35 income properties all with one lender? Ridge Lending Group specializes in investment property loans, and they do it in almost every U.S. state. Ridge has worked with tens of thousands of real estate investors and homeowners all over the country. They've been doing this for investors for so long that at this point, they've helped more families realize their dreams of becoming real estate investors than any other mortgage lender in the country. To find out more, visit ridgelendinggroup.com.
Are you looking for a roadmap to financial freedom? If so, we have a solution for you. Norada Real Estate is offering a limited number of free strategy sessions to help you get out of the rat race. Learn how you can create wealth and build monthly passive income. To set up a time with one of our knowledgeable investment counselors, simply go to noradarealestate.com. That's NORADA realestate.com.
Hi, this is Russell Gray, co-host of the Real Estate Guys radio show, and you're listening to Get Rich Education with Keith Weinhold. Don't quit your daydream.
Welcome back to Get Rich Education. Today I'm giving you my top takeaways from the terrific 9-day-long Real Estate Guys Investor Summit at Sea. And you know, no 2 days of the event were quite the same, but one typical day on the Summit at Sea might be having some investing classes in our floating conference room at sea from 8 a.m. to 1 p.m., and then spend the afternoon on a land excursion to whatever island our ship was docked at, and then maybe have another investing class or two in the evening while we were back on board the ship. And I did all of the optional land excursions too on Cozumel, Grand Cayman, Jamaica, and then finally the Bahamas. Just what an awesome time. You can find out more about the Summit at Sea and the Real Estate Guys at realestateguysradio.com. They host a number of top quality real estate investing events throughout the year. The Real Estate Guys are Robert Helms and Russell Gray. You can hear Russell Gray with me here on Get Rich Education episode 41, by the way. So the Real Estate Guys, I mean, gosh, they really assemble some of the world's top thought leaders, including that distinguished panel on the future of money in banking. Well, one of those panelists, he's part of the Summit at Sea faculty. Now, he and I had a good discussion out in the hallway after the panel had concluded, and now he's less of a real estate guy and more of a precious metals guru. And, you know, it was just kind of interesting chat. I let him know that I hold less than 2% of my personal net worth in precious metal bullion. That's gold and silver. Well, in response to this panelist out in the hallway afterward, it was of his opinion that it made more sense for me to hold about 30% of my net worth in precious metals. I'm thinking, 30? I cannot imagine voluntarily holding 30% of my portfolio, of my net worth, in something that does not provide any cash flow. There's zero income with holding precious metals. I let him know that for me to go from a position of 2% in precious metals up to 30%, then in order to get to 30%, I would have to sell real estate that throws off cash flow in order to raise enough funds to buy precious metals to get to 30%. So now I think most of you listening, you want to convert equity to cash flow when you can, right? I sure do. I mean, this scenario of trading away income producing real estate to buy more precious metals, I mean, that would have me doing the opposite. I'd be converting cash flow into equity rather than the more desirable act of converting equity into cash flow. So, I told the precious metals expert in the hallway that trading in a big chunk of my real estate for precious metals, that would result in a substantial loss in income to me. And I don't know if he had ever thought about that previously. Now, with the US's debt troubles, I think there is a good reason for international diversification in one's portfolio, which precious metals ownership basically is, right? I mean, that's why I hold nearly 2% in gold and silver bullion, and it's also why I own property in multiple countries overseas, okay? But to me, the opportunity cost of holding 30, 20, or even 10% in gold and silver, that's just too great at this time. I would have to forego too much income. I would be foregoing lifestyle just to stack up silver bars. Now, in times of uncertainty, I would tend to buy some gold. Now, Robert Kiyosaki, he had one quotable at the summit about where investors, I guess, flee in times of uncertainty. He said that white guys buy bonds, Asian guys buy gold. Okay? White guys buy bonds, Asian guys buy gold. So maybe I'm an exception here. I'm a white guy and I don't buy bonds at all. I hold a little gold as a hedge against uncertainty and as a hedge against runaway inflation. Just kind of a memorable quote that Mr. Kiyosaki gave there. So one great analogy that was brought up, it might have been off that particular speaking panel, and I forget who said it, but today, explorers will go dive in the ocean. They'll go dive down to search a sunken shipwreck if there was gold on that sunken ship, okay? But no one today goes diving down into the ocean to find a sunken ship if they think there are stacks of 100-year-old currency in a chest on some sunken ship, because currency does not have lasting value, but gold does. Gold is, as I like to say, the least worst currency in the world, and it's the only one that endures, all right? Expeditions will dive for sunken gold because it is real, enduring money. In fact, it's not currency at all, it's money, all right? So now here's one of my sidebars, one of my takes about all this perma-bear talk, recession's coming, a depression's imminent, buy gold, we're due for a crash, you better be careful. Here's just one angle that I've got on all this. Look, people have been predicting the end of the world since the beginning of the world. So yes, the United States and a lot of developed nations, we've got some deep, serious structural economic problems that aren't easily solved if they can really ever be solved. They're just kind of deferred rather than solved. I get that. I concede that point, and I feel like I've adequately hedged myself against that economic uncertainty within my risk tolerance. Hopefully you have too. Now, here's my thing. Overall, the U.S. experiences longer periods of prosperity, and that's occasionally interrupted by shorter bouts of recession, and then we're once again back into a longer period of relative prosperity again, followed by a shorter period of recession or a downturn, and then we're back into prosperity again. Okay, so I guess I'm just not going to let bearish commentary and behavior determine my every move, all right, when historically recessions make up shorter periods of time and prosperity makes up longer periods of time, okay? That's why I'm more of an optimist than a perma-bear is, but I'm still a guarded optimist, okay? I mean, it is prudent to own some gold, but, if I own too much gold, then I'm essentially back to being a saver again, if you will. People have been predicting the end of the world since the beginning of the world. Remember that. Now, on one of the days while our cruise ship was out at sea, faculty member Michael Becker, whom is both a real estate lender and a real estate syndicator, Michael gave us a really good update with what's going on with United States apartment building, lending, and investing. And Michael is right on the cutting edge. He deals with this stuff all the time. Michael is a very active practitioner. He owns a ton of apartment units himself. And as a professional lender, he also originates a ton of loans for others. So he is really in the trenches, really knows the latest with what's going on in the apartment building investing world. And by apartment building, we mean 5 or more units in a building here. First of all, Michael reminded us that the reason that you don't see any real estate built between 1987 and 1992 was largely due to the 1986 savings and loan crisis. If you're not familiar with the S&L crisis, you can go ahead and look that up. Today, most apartment building loans have LTVs, loan to value ratios, between 65 and 75%. That means you need to come to the table with 25 to 35% equity, usually in the form of a down payment, in order to get an apartment building loan. Your amortizations are usually up to 25 years. So there really isn't any change with that, okay? That 25-year amortization, that's been pretty typical in apartment building loans for a long time. 30-year fixed rate loans are just not available for apartment buildings. Michael let us know that the Cadillac, or the best of the apartment building loan products today, is Fannie Mae lending. They have 30-year amortizations, and you can get 10 to 12-year loan term. So these Fannie Mae multifamily loans, they are assumable, non-recourse, and they're up to 80% loan-to-value products, meaning you can put as little as 20% down, okay? In today's lending environment, with these lower cap rates that we have because people are paying more money for the property at the same level of income, well, you now have more and more banks doing interest-only loans for the first 1 to 3 years, which was news to me. Interest-onlys are starting to take hold again. So things are more loose now. And you know how that works. Buyers can afford to bid up the prices of apartment buildings even higher because those apartment buildings are going to cash flow better for those first 1 to 3 years in that interest-only period, because that borrower only needs to make interest payments. That borrower does not need to make any payments on the principal, so that payment is lower. That increases their cash flow, okay? And let me pick up on something. Just dropping back for a moment, I stated that Fannie Mae multifamily loans, which are the quote-unquote Cadillac, the best, the most preferred of apartment building loans, I said that they are non-recourse to the borrower, okay? Non-recourse, that means that in case a borrower defaults and can't make their payments, the bank cannot go after the borrower's personal assets because it is a non-recourse loan. Now, with a non-recourse loan, understand that the bank still has recourse on the property. The bank could still go after the property if the borrower can't make their payments, but they just cannot go after the borrower's personal assets. So keep in mind that when you're getting an apartment building loan, recourse financing versus non-recourse financing, that can be a negotiable point, and you're going to want non-recourse financing if it is at all possible. Michael Becker was here with me on episode 57 discussing multifamily apartment building loans in case you want to dig deeper into that subject. Well, there are so many takeaways from the Investor Summit at Sea, the highest end real estate investing event that I know of in the entire world. So I'm likely going to bring you more of those takeaways next week, as I'm going to refer to my personal notes from the event and give you all the best of everything. It's great to be able to bring this to you, assuming that you couldn't make it. I know that a number of the summit attendees and the faculty are Get Rich Education listeners themselves, and I appreciate you so much as well. Until next week, if you haven't yet, be sure to subscribe to the free Get Rich Education newsletter. It's sent out kind of irregularly, and, well, you might wonder just exactly what is in the newsletter. Well, in the last 3 newsletters, first of all, we had all of the questions that you must ask before hiring a property manager that landed right in your email inbox. Then in the next newsletter, you were sent the links to my favorite real estate investing and productivity websites and apps, and that gave you some extremely actionable, useful tools. There are a lot of the same ones that I use. And then the latest newsletter, that linked you to a webinar to introduce you to specific addresses of turnkey investment properties that you can buy that are not available to the general public. If that sounds of interest to you, subscribe to our free newsletter at GetRichEducation.com. Of course, your email address is never shared or sold to anyone, and you could unsubscribe at any time, but why would you? The opportunity cost of unsubscribing would be almost incalculable. So, hey, until next week, get our free wealth building newsletter at GetRichEducation.com. I'm your host, Keith Weinhold. You might quit your day job, but don't quit your daydream.
You've been listening to Get Rich Education, telling you what the wealthy won't tell you about real estate and investing. If you enjoyed the show, please take a minute to visit iTunes and leave your comments.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.